If you're a homeowner in Canada, you've probably heard the term mortgage renewal cliff quite a bit lately. There's a lot of talk and, frankly, a lot of concern about what's coming in 2025 and 2026. So, in this explainer, we're going to cut through the noise, look at the facts, and most importantly, talk about the practical strategies you can use to prepare. So, let's start with the big number that's driving this whole conversation. The Bank of Canada recently reported that about 60% of all mortgages in the country are scheduled to renew by the end of 2026. That's a huge concentration of people all facing a new rate environment at roughly the same time. And that's why this is such a critical topic for so many Canadian households. To make sense of it all, here's how we'll break it down. First, we'll look at what this renewal wave actually is. Then, we'll decode what payment shock means in real dollars. After that, we'll zoom out to see the bigger economic picture, explore 4 key strategies for your renewal, and then wrap up with a proactive plan you can follow. Okay, so what exactly is this wave? Well, it's mostly made up of mortgages that were signed back in 2020 and 2021. You'll remember that period. Interest rates were at historic lows. Millions of Canadians locked in 5-year fixed rates, many of them below 2%. Now, those 5-year terms are coming to an end, and they're renewing in a very different world for interest rates. And that brings us to this term you see everywhere, payment shock. It sounds dramatic, but it simply refers to that sudden, significant jump in your monthly payment when a very low-rate mortgage renews at a much higher modern rate. Let's actually put some real numbers to it so you can see what it looks like. This table lays it out pretty clearly. Let's imagine a homeowner took out a $500,000 mortgage in 2021 at 1.89%. Their monthly payment would have been around $2,090. Now, fast forward to 2026. Even though they've paid down their balance, a new 5-year fixed rate of, say, 4.5% would push their payment up to about $2,540. That's an extra $450 every single month. This lines up with what the Bank of Canada has been projecting, that many borrowers are looking at average payment increases of 15 to 20%. No, those individual numbers are pretty stark, I know. But it's really important to place them in the wider economic context, because the story for one household isn't always the story for the entire Canadian economy. This leads to the big question on everyone's mind. Could this wave of renewals actually trigger some kind of widespread financial crisis? Well, there's no question that individual families will feel a significant strain. The data we have suggests that a full-blown systemic breakdown isn't the most likely scenario. So here's a key distinction, which was highlighted in a recent report by TD Economics. On one hand, you have about 40% of borrowers, many with fixed-rate mortgages, who are going to see higher payments. That's the individual strain. But when you look at the aggregate national data, total mortgage payments have actually been declining. Why? Because many of the country's largest mortgages are variable rate, and they've already gotten some relief as rates have come down from their peaks. These bigger loans skew the national average, and that can mask the very real pinch being felt by a lot of individual homeowners. There are also some important financial buffers in place that help reduce the overall risk. That same TD Economics report notes that since 2020, borrowers' disposable income has gone up by about 27%, and national home prices are up over 25%. That creates a pretty significant home equity cushion. But the big one is the mortgage stress test. Almost every borrower had to prove they could afford payments at a rate at least 2 percentage points higher than their actual contract rate. That policy was designed for exactly this type of situation. Okay, with that context set, let's switch gears and talk about what you can actually do. Because knowing the numbers is one thing, but having a concrete plan is what really matters. There are steps you can take to manage your renewal well. There are really 4 main strategies to think about. You can look at making a strategic prepayment before you renew that lowers the principal amount you're refinancing. You can also review your rate type, have that serious conversation about whether fixed or variable makes more sense for you now. But let's zoom in on 2 of the most powerful strategies. Extending your amortization is often the most effective tool for immediate payment relief. It's pretty straightforward. You're just stretching your remaining mortgage balance over a longer time frame, say from 20 years back out to 30. This can dramatically lower your required monthly payment, giving you instant breathing room in your budget. And remember, you always have the option to make extra payments down the road to get back on your original timeline if your situation changes. Now, this might be the single most important piece of advice. Please do not just sign the first renewal offer your bank sends you in the mail. In this market, loyalty is rarely rewarded with the best interest rate. You need to compare quotes, work with a mortgage broker who can shop the market and negotiate for you, and find out if your mortgage is default insured. That can often qualify you for better rates. The key is to start this entire process at least 6 months before your renewal date. All of these strategies really come down to one guiding principle: being proactive. If you wait until that renewal letter shows up, you're already behind. The real power comes from getting way out ahead of the process. So here's a simple and effective timeline to follow. 6 months before your mortgage matures, make the call to your broker or your lender. Then, 4 months out, lock in a 120-day rate hold. This doesn't cost you anything, and it acts like an insurance policy. It protects you if rates go up, but you can still get a lower rate if they go down. This gives you plenty of time to make a calm, informed decision when the renewal date finally arrives. So, to sum it all up, yes, payment shock is coming. The changes are real, and for many households, the adjustment won't be easy. But it does not have to be devastating. With some early planning and good advice, the vast majority of homeowners can absolutely navigate this renewal wave successfully. At the end of the day, that's what it's all about. Knowledge and preparation are the tools that turn financial anxiety into confident, decisive action. Understanding your options, starting early, and getting professional advice, that's what puts you in control of the outcome.